All right, what's going on, everybody? Welcome back to the MIE Trading Podcast. I'm holding my mic today. I've changed my set a little bit. I think it looks pretty cool, but my new lav mic has not arrived yet, so I'm holding the big black mic today. So today we're talking about bear market basics. We're going to go over, number one, what is a bear market? Number two, what the difference is between a bear market and just your standard correction. And number three, we're going to go over how long a bear market lasts, because you may or may not have seen, on various websites, news articles, are we in a recession right now? We're not in a recession. Janet Yellen says this, she says that, Biden says this, and you might be wondering, are we actually in a recession? Are we actually in a bear market? What's the go here? So to jump right into it, the first question we said is what is a bear market? And a bear market it can be simply defined. It's simply a 20% drop in the price of an asset from its recent high. Generally, we use that figure when we're looking at stock market indexes. The most popular one is the S&P 500. So if the S&P 500 has dropped 20% from its all-time high, which is usually the most recent high, then it's like, okay, we're in a bear market now. But that definition exists and is correct to use on all assets. If Bitcoin has dropped 20% from its recent high, if oil has dropped, and so on, real estate, then that market or that sector is in a bear market. So that's a very simple way to answer the question of what is a bear market. It's a 20% drop in the price of an asset from its recent high. Okay, so now that we know that bear markets happen when we see a drop of 20% in the price of the asset, what else do we need to know? Firstly, it's that bear markets happen somewhat often, and they're just a regular part of our economic cycle. And so when we look at GDP, we have a period of expansion, we then have a peak, we have a period of contraction, and then we have the trough. And so generally, you'll have periods of expansion, of economic growth, productivity is high, people are doing well, the economy is growing, and so on. And then you'll reach a point where it peaks, it starts to drop, and then, and that's kind of like now. You see people starting to go crazy. Are we in a recession? Economic growth starts to slow, or it starts to contract. And then at the peak of hysteria and fear among people, that's when we have the trough. And that's when the market shifts, the economic cycle has completed, and then we go back into the growth cycle. Generally, the growth phase is longer and bigger than the contraction phase, and that's why over time we have overall growth and improvement in the standard of living. For example, if you look now, we have amazing things at incredibly cheap prices. Yes, you might be thinking, oh, but the prices of everything is crazy high right now. If you think of a computer 20 years ago, or even 30, it was the size of an entire room and it cost thousands. And now you can have it in your hand if you want. I mean, look at the Raspberry Pi. That's a tiny little thing, and that's a computer. And before, it used to be the size of a room, if not bigger. The size of a room used to house kilobytes or even just bytes of memory. And now we have a terabyte in the size of our thumbnail. And it's cheaper than it used to be. So yeah, you might be thinking prices are high right now, but when you look back with a broad perspective, things get cheaper and cheaper and cheaper, and quality gets higher and higher and higher. And that's because of this economic growth, increase in productivity that we see despite the periods of contraction and maybe recession that we have along the way. And this video is about a bear market, not necessarily detailing the economic cycle. But if you want to learn more about that, an amazing video that covers it in extraordinary detail, but also keeping it easy to understand, is Ray Dalio's How the Economic Machine Works. It's a great video. It's 30 minutes long. I've watched it many times, and I would recommend that to anyone who wants to learn about economics. So now we know what a bear market is, and we also know a little bit about the economic cycle and what causes a bear market. So the next thing is, what is the difference between a bear market and just your standard correction? So officially defined, a correction is a drop of greater than 10%, but less than 20%. So when you look at the recent high, if that's the recent high has been spurred on by some kind of retail trading bonanza, I don't know if that's the word, but for example, Elon Musk says, buy Bitcoin in his cryptic terms. Everyone buys Bitcoin. Bitcoin goes crazy. Bitcoin hasn't grown because Bitcoin now has actually more value. It's just hype. And so generally you're going to see a correction after that. And The correction is usually shorter term. It's between 10% and 20. And then once it is greater than 20%, that's when you can say, okay, we're in a bear market and this is more than just a correction. That might not have been the best example because that was something that actually happened. And now we are, you know, what are we down now? 70%, 80%? I don't know the number. I haven't looked very recently, but it's a lot. To put it simply, a correction is a drop of more than 10%, but less than 20%. And then the full-on bear market is greater than 20% drop. So that's the difference between correction and a bear market. So now, how long does a bear market last? Now, there's no magic pill answer. This is how long a bear market lasts. Since 1929, we've had at least 15 bear markets, and that's looking at the S&P 500. So in 1929, we had the Great Depression. We had the market lose a value of 86.2%. That's a crazy drop. Now, in the last century, of those 15 bear markets since 1929, 9 of those have been a drop between 20 and 40%, and then 5 have been greater than 40%. Now that's important because when you look at the size of the drop, and so when you have a drop of between 20 and 40%, it's generally shorter and then market recovers faster, and it's less likely to be accompanied with a recession. However, when you have a bear market accompanied with a recession, you then generally have drops that are greater than 40%, sometimes going up to 86.2%, as we said. When we look at the Great Depression, it generally lasts a lot longer and the recovery is a lot slower. So to answer the question, how long does the bear market last? On average, of those 15 bear markets we've had since 1929, on average, they've lasted 13 months before economic growth has started again. And like I said, for those smaller drops, generally it might be a little shorter than 13 months. I mean, when you look at the coronavirus market crash that we had, that was unbelievably quick, but it only lasted a couple months before economic growth bubble started to go crazy. Now, when you look at if it's accompanied with a recession, generally the period of the bear market is going to be a lot longer. The drop is going to be slower and it's going to be more painful, drawn out. And you're going to see drops likely of more than 40%. So when we look at the longest period, let's look back at that 1929 Great Depression. Just the period from the peak to the trough, that was over 62 months. That's 5 years. And then to get back to the all-time high and surpass that, that was another 5 to 10 years. I looked at this a few months ago. I can't remember the exact figure, but it was 10 years at least from the start of the recession to meeting back the all-time high. That's a crazy slow recovery. In general, let's say on average it's about 13 months. If the drop is faster, it's generally shorter. If the drop is drawn out, then the recovery also tends to be drawn out. All right, that basically covers all the notes I had about a bear market. But in addition to that, let's also talk about what causes a bear market. The most common cause of a bear market is when you see excess printing of money and lowering of interest rates by the Fed. So if they start to lower interest rates, this makes credit cheaper, and they start to increase the rate at which they are printing money. This means more money gets into the hands of consumers, credit is cheaper, so spending skyrockets. This means that more people have more stuff, more credit, more debt, and this means that prices start to get higher because demand increases, and so therefore price increases as well. And this causes inflation to grow. And then at some point, inflation reaches this point where people start panicking, prices getting too high, and so they flip the switch. They start to increase the interest rates. Credit gets more expensive. Less people can afford to take out loans. They stop printing money. So now less free money is being put into the hands of the consumers. So now there is less spending, there's less demand, therefore prices have to come down if companies want to still make their money, or as much as they can. And therefore, the economy contracts. We see a drop in prices. We see sometimes companies lay off staff. People lose their jobs. People can no longer pay back their debt that they've had for all of that credit that was so easy to get before. And then people might default. Some people lose their houses if it gets bad. And that's generally what causes a recession and big major bear markets, similar to the one we saw in 2008 and the one we see right now. When coronavirus, when that crash happened, the United States printed over 40% of the money printed ever just in response to the COVID-19 crash. That's absurd. And that's why we're seeing inflation right now well over 8%, approaching 9%. That's crazy numbers. And it's because they printed so much money, so many people had so much money, let's go spend all this free money. What a company's going to do when the demand for their stuff is crazy high? Raise prices. That's why inflation's gone crazy. And now you're seeing the interest rates being jacked up by 75 basis points as per the most recent hike. Now credit's more expensive. People can't buy things. People are losing money. We're probably going to see people start to lose jobs, and that's why we're seeing the S&P drop in price right now, and it's probably going to keep dropping in price for another 6 months, I assume. Yeah, that's a little spiel about what causes a bear market. Maybe that's useful to you. You might be able to look into some things and make your own projections for how long you think this bear market is going to last, and maybe you could make some plays. Let's say you might be able to short the market. You might wait for a good time to go long on the market. You could maybe get close to the bottom and then profit from the almost guaranteed recovery. Every single bear market and every single recession we've had in the past, we've recovered from it. And, you know, can't predict the future, but we're going to recover from this one too, obviously. So yeah, hopefully these tips, you find them valuable. Hopefully this video helped you to learn what a bear market is, maybe help you deal with the one that we're in right now. Next week, I'm going to be going over tips for surviving the bear market. So these are going to be some practical tips that you can use to basically increase your quality of life or avoid those bad things happening, such as losing money, not being able to pay back debt, losing your job, and so on and so on. So keep an eye out for that, and make sure that you subscribe to the channel if you want to stay notified of the latest videos I release and you want to learn the newest ways to improve your trading based on what we know works. Also click the little bell because you don't get notified without doing that. Anyway, thanks very much for watching the video. Make sure to like the video if you liked it, dislike it if you dislike it, but they don't show up anymore. Leave a comment on what you thought, maybe some other things you'd like me to cover. That would be cool. Share it if you have a friend you think will find valuable. You know, all the cool stuff. And you go to my website, mie.trade, and get access to my brand new trading analytics platform. It automatically analyzes your trades and tells you exactly how to improve your trading based on what's proven to work for you and what's proven not to work. It'll say, do this, don't do that. So if that sounds good, go to mie.trade to get that. Otherwise, thanks very much for watching, and bye-bye. I'll see you next week.